We're not expecting lenders to move on the loan prime rate, though, given that really nothing happened with the MLF last week. So when are you expecting this policy support to start helping equities in the broader markets?
Well, I think right now policymakers are really more focused on ensuring that some of the property market woes don't spread into the wider banking industry. And I think that could come in the form of greater credit support, both in terms of making it easier for households to get mortgages and easing some mortgage restrictions, and also some assistance with developers getting some financing for their existing projects. So I think that's in the near term. For the second half of this year, I continue to expect further policy rate cuts, perhaps once more on the triple R rate, and then perhaps even a small cut in the loan prime rate as well.
We have seen the rally here in the U.S. markets really after a lot of negativity was already priced into the earnings. Any sort of upside surprise is really helping markets, especially in the tech sector. We've seen a lot of regulatory hurdles in China as well. Would you touch those right now?
Well, I think from an earnings perspective, Chinese earnings estimates might still have to come down a little bit more, and we'll see that perhaps during the second quarter earnings cycle. But I think that investors will certainly want to be positioned for next year's earnings, which are looking to be quite solid, especially from a low base effect. From a China tech perspective, I think that we'll continue to see piecemeal regulatory measures come out of Beijing, but I think the bulk of the regulatory measures have already been undertaken. And I think that it's possible that we could see a bit of relief for investors looking to get involved in Chinese internet and tech companies.
When it comes to dollar strength, that's been one of the headwinds for broader Asian equities. Are you expecting that to be alleviated a little bit, given that we have seen this pullback over the past 3 days?
That's right. I think that dollar strength, I think that narrative will certainly start to wane once investors get a much better sense of peak Fed hawkishness, and I think that could potentially come this month. I don't think that there are expectations among Fed funds futures that that the policy rate is going to rise by more than 75 basis points. And if that's the case, I think the dollar strength could start to fade, perhaps even starting as early as next month.
What are the other big risks for the Asia Pacific? Because this is broadly a region where we are still hopeful that there might be patches of growth.
Well, I think that the biggest risk is to the APAC region is from global macro weakness and potential recessionary risks. And I think that really stems from Europe first, perhaps already slipping into stagflation, and then perhaps followed by the US, which could see a recession perhaps in the next few quarters. Now, that's certainly not a done deal. And I think that it's possible that central banks can negotiate still a relatively softer landing. Now, for Asia's export-oriented economies, that could potentially be a significant hurdle, as there could be decreased demand for their products.
David, I'm surprised that in one of your calls, you're calling for overweight on EM government bonds, when this chart on the Bloomberg clearly shows that we continue to see those EM debt risk premia rise. We have seen, of course, the warnings come from the IMF, Kristalina Georgieva herself talking about a third shock of tightening potentially coming and potentially more defaults. So how do you position in such an uncertain environment?
Sure, I think that it's an environment where we have to be selective about, even within asset classes, even within EM bonds. Certainly EM countries that are net energy exporters will do better in this environment. And also certain EM countries that have more fiscally sound balance sheets should also do well. But certainly that entire asset class right now is on sale. And we're starting to see significant yields that are at much more interesting levels now than, say, just a year ago. So I think that investors should stay broadly diversified, and EM bonds is EM government bonds is one of the diversifiers that I think should be looked at.
Talking about those commodities exporters in the EM space, we have seen a little bit of pressure on that side as well, and it will just get worse if we actually do in fact see a recession for the U.S. Chinese demand waning as well. So how do you factor in where commodities are at this point and where you see them in the next year?
Well, I think that commodities, broadly speaking, are continued to be an asset class that investors should continue to look at. But I would say that when it comes to energy, if we look at the supply side and the investments, CapEx investments made for energy and oil over the past decade, there's been significant underinvestment. So I think that the supply side for oil continues to make it an interesting investment. Now, when it comes to agriculture, I don't think that we've seen perhaps the bottom of the current scarcity. So I think that agriculture continues to be a very interesting investment opportunity as well.